Hey, good morning. This is Mayor Valensky with Driving Markets. Hope you're all well. Okay, let's kick off. So let's look at what is actually driving the markets at the moment. If you remember, last November, December, the markets were in a bear cycle. Bear cycle means they're going down. That was due to high interest rates and high inflation. Also, the outlook in 2022 looked pretty negative. Now, I was stating in December and also January that it would continue throughout 2023, expecting the markets to go down. But I got it wrong. I got it 100% wrong that the markets are going down. The markets are actually climbing up. So you've got to admit it that when you make a mistake, you make a mistake. And therefore, when I stated that the markets are going to go down in January, it turns out since January to date, markets have just gone up. And the trend line is up. So I need to actually point out a couple of things. Number one, to my very serious colleague Phil, you are 100% right, okay? You said that the markets would go up in January. You are right. I was wrong. Absolutely spot on, okay? Give credit where credit is due. Wrong. Driving markets, Mayor Valensky was 100% wrong. Markets are going up. Jimmy Beer in London. Jimmy, hope you're well. Yes, you're absolutely right. Every estimation or guess I made this year is wrong. And you keep saying, look at all my YouTubes, everything's wrong. Jimmy, spot on. You're always 100% right. So again, you've got to admit when you're wrong, you're wrong. Okay. What has actually been driving markets since January? There's one sector and one sector only that's been driving markets, and that is technology. The tech sector has simply driven markets all the way up to where they are at the moment. So you had the markets in the doldrums last year, which was Meta down to $92 a share. I think Tesla got down to like $101 a share. Amazon was down. Alphabet was down. Google was down. Obviously, Google, Alphabet, the same thing. Apple was down. They were all down. They all looked like they were going to go down further. And then they turned around on the back of the prospect of lower interest rates or interest rates not rising anymore. And the headline inflation was coming down. So the market was looking for a reason or an excuse to move up. Even though the cost of living is going up, even though mortgages were going up, even though interest rates were going up, even though companies were going bankrupt, some famous ones like Victoria's Secret or Hertz Rent-A-Car, the market is discounted, disregarded, ignored any particular bad business economic news. It's only focused on one thing, and that has been AI, GBT, so artificial intelligence, and chat GBT is generative something text. Can't remember now. I'm sure you'll correct me when you're watching this YouTube channel. So those are the two things that have driven the tech sector. Economically, macro is the prospect of lower interest rates or no rising interest rates and lower inflation. Okay, so where do we go from here? Now that I had it wrong since January and got to eat humble pie, admitted it, so you can't keep reminding me you got it wrong. I admitted it, got it wrong. Where do we go from here? We're going, in my opinion, I could be wrong again, could be wrong over the next 7 months, over the next year and a half. We are going into a tech bubble. That's my opinion. That's based on the factors around me. Look at the NASDAQ. The NASDAQ is made up of 7 components, 2 of which form nearly 25% of the index, Microsoft and Apple. So as long as Microsoft and Apple are rising, then the probability is that the NASDAQ will rise. You've got NVIDIA in there. You've got Tesla in there. You've got Meta in there. And you've got Alphabet in there. So by the 7 top companies, another one, Alphabet, Google, another Alphabet. So it's 7 top companies are controlling the NASDAQ, or 55%, as Phil sent me a message yesterday. 55% of the NASDAQ is made up by 7 top high-tech companies. The rest of the NASDAQ are either not making money or not performing. But those top 7 companies, those mega global companies, are pulling up the NASDAQ and pulling up the tech sector. So the tech sector is forming into a very narrow-based bubble. And if any of those 7 companies were to drop, then the NASDAQ would fall significantly. So the question is, are these big companies going to fall, or are they just going to continue going up and up and up? We're talking about the Microsofts, the Apples, the Teslas, Nvidias, and Google, Alphabet, etc. Are they just going to continue rising, or are they ever going to fall? Well, at some stage, they are going to fall. But whether they're going to fall based on driving markets predictions, I don't know. Based on this year's predictions from January to where we are now, no. Okay, that's it. So that's on the tech sector. So I think we've got a bubble forming. I think it's going to pop. If we move on to the foreign exchange, there I was a little bit more successful in quoting that the dollar yen is going to go through the roof, which it did. When I was quoting it, it was down about 127, 128, and it's moved all the way up to 141. It has touched 145. Bank of Japan will intervene at 145. That's pretty odds on favorite. Pound. Pound is strengthened on the back of the prospect of rising interest rates in the UK. So pound dollar is 128, looking okay, probably going to go to 129. Pound dollar is called cable, for those who don't know. Euro dollar steady at 109. Bitcoin at 30,000, 30,400. Not sure where it's going. I think it's going to go up. It's just got that feeling that's going to go up. Okay, it's ready for, it's stabilizing before it has a big jump up. What else do we have? We've got property prices. Property prices in the UK have fallen slightly, 2.6% year on year. However, it looks like asking prices are still being matched for some reason because there's a shortage of property. Property prices in the US are also going up due to shortage or lack of supply of inventory. Bond yields, another indicator which the markets seem to ignore, the divergence between the 2-year yield and the 10-year yield. 2-year Treasury in the US, 10-year Treasury in the US, divergence. The yield on the 2-year is higher than the 10-year. That is a lead indicator of a recession. But for some reason, equity markets seem to be ignoring it. You add all this together and it looks very, very strange. GDP, not sure where that's going. Growth is limited in the US, also in the UK and in Europe, but markets seem to ignore it. As far as gold is concerned, gold is a risk, is a asset whereby it is secured in times of stress. So at the moment it's risk off on gold. So gold is likely to float down to test the 1900 level. If it falls below 1900, then 1890 is the very big support. From there, if it breaks below that, could go all the way down to 1850. However, if it holds at 1900, or there's a geopolitical issue, or there is fear, then it could see gold riding all the way up to 2000. My medium-term 6-month goal on gold is 2100 to 2200 on gold. Oil is steady at $73 a barrel. Again, it's come off in times of recession. You can see oil will fall significantly. So overall, the first 7 months of this year, as you viewers wanted to hear, the ones who are very, very bullish and call me a big bear, I got it wrong. What are you going to do with that now? So I admitted it. Great. You can comment, share, subscribe, feedback, whatever you want. The idea is to give you as much information as possible and as much positive information as possible to help you trade. This is Mayor Walensky with Driving Markets. Catch you later.